All right, let's talk about two worlds that, on the surface, could not be more different: corporate finance and enterprise architecture. They really do feel like they're from completely separate planets. But what if I told you they actually share the same DNA? Let's dive in and see how deep this unlikely connection really goes.
Okay, so on one hand, you've got corporate finance. You hear things like capital allocation, shareholder value, risk. It feels very Wall Street, right? High-stakes decisions. And on the other hand, you have enterprise architecture. That's the world of systems, technology strategy, capabilities. It kind of feels like the engine room of a modern company.
So you've got to be asking the big question here: what on earth could one possibly teach the other? Well, it turns out a whole lot. Because the logic they both have to use to make really good, high-stakes decisions is almost identical. So here's how we're going to break it down. We're going to look at 4 key lessons from the world of finance and see how they map directly to architecture. We'll start with opportunity cost, then move to agency costs, the value of options, and the idea to invest, then finance. And then we'll tie it all together to find out what the real bottom line is.
Okay, let's jump right into our first lesson: opportunity cost. Now, this is a concept that sounds pretty simple, but it is incredibly powerful. The idea is this: it's not good enough for your project to just be good. It has to be better than the next best thing you could have done with that same time and money.
In finance, they call this the hurdle rate. It's basically the return shareholders could have gotten if they invested somewhere else. And if your company project can't beat that rate, well, you're actually destroying value. The most important question you can ask is always, what else could we be doing with these resources?
So how does this play out in architecture? Well, let's make it real. Imagine you're choosing between building a totally custom integration platform and just buying an off-the-shelf one. Now, your custom platform, it might work perfectly for its one job, but the off-the-shelf option, it doesn't just work, it actually speeds up 2 other big projects and lowers your overall risk. See, even if your custom build is a technical masterpiece, it's failed the opportunity cost test because there was a better alternative on the table.
Now let's move on to our second lesson, which is all about the human element: agency costs. This is what happens when the people making the decisions have totally different goals than the people who actually have to deal with the results.
In finance, this is a classic concept called the principal-agent problem. You've got the principal, let's say the company's owners, and they delegate a decision to an agent, like a manager. But if that manager's personal goals don't line up perfectly with the owner's goals, you get these things called agency costs. It's like value is just leaking out of the system because of that tiny misalignment.
And wow, does this hit home in the tech world? The business, that's the principal, it just wants overall value for the whole company. But look at all the agents. Product managers, they're trying to hit their delivery metrics. Makes sense. Infrastructure teams, they're focused on keeping everything stable. Also makes sense. And the vendors, they just want to get that contract renewed. Every single one of them is making a perfectly rational decision from their own little corner of the world.
But what happens when you add up all those rational local decisions? You get this: an architecture that nobody actually wanted or chose. It just emerges. You end up with this Frankenstein's monster of a system where every individual decision made sense at the time, but the whole thing is now a giant, costly mess.
All right, on to our third lesson, the value of options. This is all about risk, flexibility, and a simple truth. A dollar you're sure you'll get is worth more than a dollar you might get. That means keeping your options open for the future has real, concrete value right now. Now, think about this in terms of how we build systems. On one side, you have the big, tightly coupled monolith. It almost always looks cheaper and faster to build up first, but what you're really doing is selling off your future flexibility. It locks you in, and making any changes down the road becomes incredibly expensive and painful. But on the other side, you have a modular, replaceable system. Yeah, it might cost more up front, but what you're buying is optionality. You're buying the ability to adapt and change course later.
And here is the absolute key. That hidden cost, the price of being inflexible, is almost never, ever captured in a business case. We get so focused on the upfront build cost that we completely ignore the massive future costs of being painted into a corner.
Okay, this brings us to our fourth and final lesson, and it's a big one that separates strategy from just doing the work. Invest, then finance. The idea here is that your investment decision, that is, what you decide to build, creates way more value than your financing decision, which is how you decide to build it.
And here's the perfect architectural parallel. Your investment is your architecture strategy. It's choosing the right capabilities, the right platforms. Your financing, on the other hand, is your execution. That's your cool DevOps tools, your agile ceremonies, all the ways you optimize delivery. Both are important, for sure, but strategy has way more impact.
Because think about it. If you get the investment part wrong, the best execution on the planet can't save you. This quote just nails it. If your architecture is evolving a capability the business no longer needs, no amount of execution excellence will recover that value. You can be the most efficient team in history, building the wrong thing, and it's all just sophisticated waste.
So let's pull all 4 of these lessons together and figure out the real bottom line. Because this isn't just about some clever analogies. This is about a fundamental mind shift. It's about starting to see enterprise architecture for what it really is, a discipline of allocating scarce resources in a world of uncertainty.
So, using what we've learned, we can literally build a new framework for every single decision we make. Number 1, consider the opportunity cost. What are we giving up to do this? Number 2, identify the agency costs. Are different teams pulling in opposite directions? 3, value the optionality. Are we locking ourselves in for the future? And finally, number 4, focus on the investment. Are we absolutely sure we're building the right thing in the first place?
And when you start looking at it through that lens, the connection becomes crystal clear. Architecture decisions have the exact same structure as the big capital allocation decisions made in finance, and the consequences of getting them wrong are just as permanent and just as damaging.
Which leaves us with this final, really powerful thought. The true cost of a bad architecture decision isn't just the money you wasted on it. No, the real cost is everything the company could have built with that time, with that money, and with those people instead. It's the lost future. So the question to leave you with is, what amazing things could your organization build if it started getting these decisions right?